Okay, we now move to the risk management for hedge funds. And new risk management tools are required to capture risk exposure for a variety of dynamic hedge fund strategies. Then, from the investment perspective of hedge fund manager is very different. The fund manager is very different from institutional investor. There is no positional transparency or risk transparency with hedge funds, as they are not subject to the same degree of accountability or regulation requirement. Traditionally, static risk measures such as value at risk do not address the wide range of risk associated with hedge funds. For example, VAR is an unconditional statistic measure of risk, while hedge funds may vary strategy based on changing economic conditions. Market VAR does not capture time varying risk, credit risk, liquidity risk, event risk, factor exposure risk. In addition to lack of transparency, empirical studies of hedge funds are subject to survivorship bias because inactive funds are seldom included in the database. Phase locking behavior and asymmetric correlation are further examples of non-linear risk that the traditional risk measure do not capture. New metrics such as Q statistic and the analysis of serial correlation provide valuable insight regarding underlying liquidity of hedge funds. The first topic here is institutional investor versus hedge fund manager. Compare and contrast the investment perspective between institutional investor and hedge fund manager. Hedge fund manager and institutional investor have very different investment perspective, but both desire superior investment performance. Institutional investor have special fiduciary responsibility to understand and explain the investment process. Hedge fund manager, on the other hand, determine the appropriate risk return trade-off without the same level of fiduciary disclosure, since they do not operate under the same regulatory constraints. They are instead allowed to protect proprietary strategies by not revealing positional transparency. Therefore, hedge fund manager enjoy the freedom to switch asset allocation and trading strategy without pre-disclosure of risk return characteristic that institutional investors are required to maintain. The primary and often only objective for hedge fund is to maximize return, while institutional investors are typically concerned with risk return, tracking error, benchmarking, peer comparison. The unique nature of hedge fund creates challenges for risk management due to lack of risk transparency. Thus, risk manager and risk transparency are essential for institutional investors, but not for hedge funds. Five unique aspects of risk management for hedge funds that create challenges are survivorship bias, dynamic risk analytics, non-linearities, liquidity issues, and risk preferences. Hedge funds are designed to avoid regulatory constraint and compliance issues. Conversely, the federal and the state compliance are very strict for pension plan sponsors and other fiduciaries. Intellectual property is a valuable asset that is owned by institutions and is a product of numerous managers. However, there is little intellectual property with hedge funds, where it is common for one manager to have sole responsibility of the fund. Now, if we look at the hedge fund manager, different institutional investor with different characteristic, and we'll compare this with institutional investor. We'll compare accountability, trading strategy, performance disclosure, risk management, regulatory environment, and intellectual property. Now, for the hedge fund manager, accountability, managers determines appropriate risk return trade-off, whereas accountability for institutional have fiduciary responsibility to understand and explain investment process. For trading strategy, proprietary and closely guarded, manager must fully disclose risk exposure and must maintain strategy consistent with the institution's object. Performance object, return are primary objective. Return, tracking error, benchmark, peer comparison, all are important objective. Risk management is not required. Risk management and transparency are required. Fund is designed to avoid regulatory compliance constraint, highly regulated environment subject to federal, state compliance, pension plan, sponsor other fiduciaries. Little intellectual property, since general partner is the fund, well-defined institutional investment process that is not dependent on one manager. Generating alpha with risk manager, next topic. Explain how proper risk management can itself be a source of alpha for hedge fund. Hedge fund manager often accept more risk for higher returns. However, a major axiom of modern portfolio theory is a trade-off between risk and return. Higher risks are associated with higher return. If the manager is able to truncate risk to proper risk management, then alpha returns are possible. The following example illustrate how risk management can be used to create alpha. Suppose a hedge fund has an expected annual return of 10% and annual standard deviation of 50%. This hedge fund uses a risk management strategy that limits downside risk to minus 10%. Assuming returns follow log normal distribution, we can now give table of log normal distribution returns with various explanations, standard deviation and truncation point to find the expected annual return with the incorporation of risk management strategy. We find that expected return when eliminating returns below minus 10% will actually increase to 18.9%, nearly double the original expected return, which illustrates the value of managing risk. An obvious downside to risk management strategy is the cost of implementation. For example, cost of implementation of portfolio return floor of -20 by purchasing put option would be estimated at 15.4% of total asset of the Black-Scholes model. This assumes 5% risk-free rate. Strike price of put is 12% out of the money and volatility is 75%. More effective risk strategy, but the more it will contribute to manager's alpha return. So now we move to limitation of VAR when analyzing hedge funds. Explain the limitation of VAR measure in capturing the spectrum of hedge fund risk. Value at risk is commonly used risk measurement technique that estimates the amount of loss for a specified time period. The estimates are typically calculated using volatilities and correlation from historical data. In this section, we will discuss limitation using the VAR technique and measure hedge fund risk. The first limitation of VAR as a risk measure for hedge fund is related to the fact that hedge fund exhibit a wide spectrum of risk. Key components of hedge fund can vary greatly, which contributes to heterogeneity of the risk for hedge fund. For example, if you consider differences that can exist between risk of a long-short equity hedge fund and a fixed income hedge fund. Key components of typical long-short hedge funds include the following: investment style, fundamental analysis, estimation of factor exposure, portfolio optimization, short selling limitation, execution cost, benchmarking and tracking error. Key components of typical fixed income hedge fund include yield curve models, prepayment model, option feature, credit risk, inflammatory pressure, macroeconomic events. As you can see, the key components and risks for these two types of hedge fund vary greatly. Computing these differences, hedge fund manager may have greater freedom in managing their investment compared to institutional asset manager. A second limitation of VAR is purely a statistical measure of risk that does not capture unique risk associated with different underlying economic conditions. VAR was originally designed to measure risk exposure of a portfolio consisting of derivative in terms of amount of loss corresponding to 5% of tail probability. Thus, VAR may not apply to other types of investment common to hedge fund. Example: emerging market debt, risk arbitrage or convertible bond arbitrage. Hedge fund manager often use dynamic trading strategies that vary with time and market condition. Market VAR does not capture these time varying risk or other type of risk such as liquidity risk, event and credit risk. A third limitation of VAR is that it is difficult to estimate due to uncertainty of tail exposure for different economic situation. Tail even happen infrequently and therefore difficult to associate with accurate probability. Historical data captures only a few events, and this sample size is often too small for reliable estimate. Another problem related to tail event occurs when VAR is used as a risk measure under assumption that returns are normally distributed. In this case, tail limits are estimated based on mean and standard deviation of underlying distribution rather than the occurrence of the rare event. This is a problem because the hedge fund returns are not normally distributed. They are often highly skewed and asymmetric distribution with fat tails, which imply greater probability of occurrence of rare tail events. A fourth limitation of VAR is that VAR is an unconditional measurement of risk. The term unconditional difference the underlying distribution. This is a drawback because hedge funds are often actively managed based on conditional measure. For example, VAR measure of portfolio over the next week is 20 million under normal economic condition. Alternatively, a VAR portfolio measure based on changing underlying condition may yield a VAR of 100 million. Historically, data suggests that asset classes are more highly correlated in market classes. Clearly, VAR is not designed to measure the risk associated with hedge funds. Thus, traditional risk measure designed for static or conditional environment may have many limitations with respect to hedge fund analysis. The unique characteristic of hedge fund require new risk measurement tools to address the dynamic strategy and conditions. Now we look at the survivorship bias. Explain how survivorship bias poses a challenge for hedge fund analysis. Historical data is used to analyze the risk of a portfolio strategies. However, a hedge fund discloses the historical data that hedge fund is seldom included in the data. The reason for hedge fund funds removed is twofold. First, investor desire the funds that are investable. Secondly, funds that shut down do not wish to disclose data for legal reason. The exclusion of data from funds that are no longer active is known as survivorship bias. A few studies have included data from inactive funds have found significantly different results when survivorship bias is not present. To illustrate the importance of survivorship bias, suppose there are n funds, return R1 to Rn, excess return per unit risk are defined using Sharpe ratio, which is Rj minus Rf upon sigma j standard deviation. In addition, we assume the returns are independent and identically distributed with the distribution function fx. Suppose a group of hedge fund portfolio managers are ranked based on the portfolio actual realized performance. In addition, assume that none of the manager possesses super selection skills. This implies that the expected excess return per unit risk for all funds are zero. The best performing fund is no better than the worst performing fund because there is no alpha. Selection bias will occur if we falsely assume that one of the managers has superior selection skill. A fund may be ranked as superior based solely on the realized performance of the fund without considering the fact that we selected it from a population of funds. Figure 2 further illustrate the concept of selection bias. The mean and standard deviation of the realized excess return per unit risk X star are reported to be best performance out of the sample and funds. Assuming Xj is a standard normal variable, the selection bias for a sample of only 5 funds implies an excess unit of risk ratio of 1.163. As the sample size is increased, the bias increased to 2.043 for a sample of 30 funds. So there is a selection bias for manager performance. If we assume no manager possesses superior skills and no alpha is present, then historical performance is entirely random and best performing fund goes forward is unknown. Majority of database of hedge fund only include current active fund, and thus the investor must adjust for survivorship bias to construct an optimum portfolio when including a hedge fund. We now move to the next topic, which is the measuring risk of a dynamic investment strategy. Describe how dynamic investment strategies complicate the risk measurement process for hedge fund. Hedge fund manager incorporates a variety of strategies due to freedom from regulatory constraint. They are able to use leverage, trade actively, adjust asset allocation, and switch trading strategies frequently. These dynamic investment strategies create constantly changing risk exposure. As you have learned, modern economic theory evaluates systematic risk based on the beta measure, which is designed to explain risk for static investment. However, with dynamic investment strategies, no single risk measure can explain the inherent exposure by hedge fund manager. To confound the problem of accurately measuring risk, there is no requirement position transparency with hedge fund. Thus, hedge fund managers are able to protect their proprietary trading strategies. A hypothetical hedge fund can be used to illustrate how difficult it is to measure the risk for varying strategies by comparing result of a trading strategy and the S&P index. Suppose a hedging fund strategy is to short index. A put option with strike price 7% out of the money, so and have maturity dates less or equal to 3 months date. Then we compare the short put hedge fund strategy with S&P index using monthly returns. The first impression suggests that impressive returns for hedge fund, which is normally a mean return of 3.7 as compared to 500 a month mean return of 1.4. The annual Sharpe ratio for hedge fund is 1.94 as compared to 0.94. This strategy was implemented for Jan 1 to 92 to 99. The total returns of the hedge fund would have been 2,721% compared to 3,600 for S&P index. As noted earlier, the traditional risk does not capture the correct risk exposure for the hedge fund. Hedge funds are required not to disclose their trading strategy, which is problematic since some manager may actually implement a simplistic strategy. It is doubtful that an investor would pay hedge fund for performing fees for following a simple strategy. However, due to lack of transparency, most hedge fund strategies investors are not able to detect such behavior without measuring the capture needed for dynamic risk. Now that's why they have compared the short put strategy here. Consider another example of a hedge fund using delta hedging strategy. Delta hedging strategy synthetically replicates short position. Suppose a hedge fund creates an European put option of shares expiring in 2 years. Also assume the synthetic put option has a price, and as you can see, this strategy involves deep out of the money put option, and this is a contrarian strategy where the position in XYZ is increased when the price declines. Now suppose that a hedge fund manager duplicates delta hedging strategy for 500 funds. The strategy would require significant amount of leverage. However, without additional risk address the dynamic nature of strategy, it would be impossible for an investor to truly understand the strategy's risk. Even if the firm discloses the total position transfer, the underlying risk is still not clear. As discussed, traditionally mean one risk framework based on static strategies are not applicable for dynamic strategies such as short out of the money put options or delta hedging deep out of the money synthetic puts. Hedge funds that short out the money put will result in a positive returns and will have greater return than S&P index most of the time. However, when returns are negative, they are significantly lower for put strategy. This is a standard deviation does not capture the amount of tail risk of the strategy. Therefore, standard risk measurement tools by hedge fund are not sufficient for capturing this dynamic strategy. We now move to the non-linearities in the hedge fund. Describe how the phase lock phenomena and non-linearity in the hedge funds can incorporate into a risk model. Phase locking behavior occurs with an event that causes normally uncorrelated actions to become highly correlated. So that's phase locking event. For example, in the summer of 1918, Russian government defaulted on its debt. The default eventually started a global crisis where assets that normally had correlation of 0 move together with a correlation close to 1. It is necessary to explicitly allow the occurrence of phase logging events in risk models in order to capture their perfect impact on hedge fund. Suppose returns are generated by the following two factors, and we have market component, phase locking component of catastrophic event, and idiosyncratic risk. And then we have the equation here, that is return on the fund is the fund intercept, fund sensitivity to market, phase locking component, and idiosyncratic. In addition, they are independent identically distributed variables. And phase locking event is again with probability p or 0 with probability 1 minus p. When the probability of phase locking event is very small, then the expected return for the fund just comprises of alpha 1 plus beta I into market. However, when phase locking event is more probable, the third component zt impacts the return of the fund. The common factor zt will dominate the expected return when there is phase locking behavior, and the volatility of the common factor is generally larger than the volatility of the market factor and the error term. The conditional correlation coefficient for two funds Ij when there is no phase locking is very different when there is phase locking. So the condition correlation for funds Ij can also be defined when phase locking event is equal to 1 versus when phase locking equal to 0. If the volatility common factor Z is significantly larger than the volatility idiosyncrasies for both funds, Bi and Bj are approximately 0, then the previous correlation equation will be roughly equal to 1. When catastrophic events occur, the volatility of the catastrophic event will most likely be very high. This will result in the increasing the correlation to a point close to 1 for two funds that under normal condition would have correlation close to 0. The correlation measure most commonly uses VAR calculation, but portfolio optimization risk reports are known as unconditional correlation. This measure is formulated by unconditional covariance divided by the product of square root of unconditional variances. One of the hidden implications of equation 1 is that unconditional correlation is very small. However, it tends to increase as the variation of phase locking component increases. For example, if the variance of the phase locking component is 10 times greater than the variance of the residuals, then the unconditional correlation is approximately equal to 0.01. If the phase locking component is 100 times greater than the variance of the residuals, then the unconditional correlation equals to 0.1. This explicitly risk the explicit risk model defined allows for a detection of phase locking component from standard coefficient. Without such risk, phase locking component is virtually impossible to detect. Asymmetric correlation refer to the notion that beta coefficient are more highly correlated with market index in downturn than they are in up market. Thus, asymmetric correlation creates another non-linearity risk that the traditional risk measure do not capture. This is captured by a regression model. This regression was specifically used to analyze hedge fund returns from 96 to 99. Monthly hedge fund returns were separated into positive and negative returns and analyzed with S&P as the market index. Results from emerging market equity index and option arbitrage index illustrate the beta symmetries that are present during this time. The emerging market equity hedge fund has an up market beta of 0.6 and a down market beta of 1.49. The relative value of arbitrage index has an up market beta of minus 0.78 and a down market beta of 0.33. Numerous types of hedge fund were tested for same methodology and yielded similar result. These examples suggest that hedge fund cannot be truly market neutral. Empirical results suggest that the need for dynamic risk measurement models that can account for phase locking behavior, asymmetries in exposure, and other non-linearity that occurs with active hedge fund strategies. Non-linear risk models for all types of hedge funds should address the following factors: credit, liquidity, market index return, sector type, volatility, and macroeconomic indicators. The last topic here is measurement of asset liquidity. We need to explain how correlation of returns can be used to measure liquidity of the assets. Consider an unrealistic extreme event of market efficiency where all market movements are totally random. The Martingale model is one of the earliest asset pricing model where asset returns are assumed to be serially uncorrelated. In other words, the correlation for all assets have a correlation of 0 with one another. If markets are efficient with respect to information, then pricing changes cannot be forecasted. Thus, a market becomes more efficient with respect to information. Price change becomes more random. Market inefficiencies could result in a portfolio are more quickly observed as the number of market participants seeking inefficiencies increases. In the real world, friction exists in form of transaction cost, borrowing cost, information cost, institutional restriction. These market imperfection causes asset return to exhibit serial autocorrelation. Illiquidity is one of the most common forms of market friction. The autocorrelations are useful indicator of liquidity for the underlying asset. The degree of serial autocorrelation in an asset's return is a proxy for account of illiquidity function that is present. More liquid asset exhibit less autocorrelation with liquidity asset. For example, residential real estate investment are very illiquid and historical return exhibit much more high autocorrelation than the returns of S&P 500. In 1965, Samuel suggested that predictability in asset returns will exploited and limit only to the extent allowed by market friction. Therefore, if residential real estate returns are highly predictable, it is not easy to profit from these predictions. The high transaction cost associated with real estate transaction, the inability to short sell properties, and other market friction make it to profit from the predictions in the real estate market. Another reason for autocorrelation or important proxy for estimating liquidity is related to calculation of hedge funds NAV. The market price is difficult to determine for assets that are not frequently traded. So illiquidity allows hedge fund manager considerable discretion in determining portfolio's value at the end of the month, which is used to calculate NAV. Hedge fund managers have an incentive to smooth their returns over the time because their compensation contracts are based on performance. Smoothing returns over time also decreases the volatility of the fund, which increases the Sharpe ratio. When hedge funds are smooth returns over time, the smoothing process creates serial correlation. Now, Lung and Vox proposed a statistic as a summary measure of overall statistical significance. The statistic is approximately chi-square distribution with m degree of freedom of no autocorrelation. The Q statistic, sometimes referred to as Legendre-Box Q statistic, reflects absolute magnitudes of correlation because it sums the squared autocorrelation. The signs do not cancel each other, and the funds with large positive or negative autocorrelation result in large Q statistic. Now, contrasting serial correlation and Q statistic for monthly returns of simple mutual funds and hedge fund. When there has been figure reported by the number of months, standard deviation, autocorrelation, and p values and Q statistic which were calculated. So large mutual funds typically invest in highly liquid securities. Therefore, it is not surprising that serial autocorrelation for mutual fund is low. Additionally, SEC regulation, detailed perspective, and daily NAV calculation prevent price manipulation or smoothing of return. Conversely, hedge fund sample reveals significant autocorrelation and Q statistic that are reflective of potential return smoothing and illiquidity of underlying securities. Thus, the results suggest autocorrelation, and the Q statistic provide valuable risk metric for liquidity exposure in the hedge fund. Now, there are other issues to consider. Risk preferences are important from both managers and investors' perspective. Hedge fund managers are often compensated with non-linear payoff based on fixed and performance incentives. Thus, there is an incentive for excessive risk taking on the part of the manager. In addition, behavior of investor also influences hedge fund manager. Hedge fund investment are sometimes referred to as hot money, which may encourage hedge fund manager to become more aggressive in taking risks. Furthermore, lockup periods are often imposed to prevent investor from panicking and running in a period of poor performance. Risk management tool also consider these risk preferences of both manager and investor. Operation risk refer to organization characteristics such as back office operation, legal infrastructure, accounting practices, personal trading, management practices. These risks, while trading are difficult to quantify, should not be ignored. Institutional investors such as pension fund may find that hedge funds are good fit for their optimal risk portfolio. However, fiduciary responsibility require better risk measure that reflect risk transparency of hedge fund. For example, the plan support sponsor manages pension fund assets to minimize the risk of defaulting on plan's liability. However, a completely immunized portfolio against default is too costly to obtain. Thus, a manager maintains a surplus asset to liabilities to help control this risk. It is not clear how much surplus there should be and what's acceptable level of default risk for different time horizons such as 1, 5, 20 years. Better risk management measurement that captures these dynamic aspects of pension funds are required for finding the optimal risk exposure for pension portfolio that include hedge funds. So I quickly return on the last point. The Q statistic is an absolute measure of correlation because it sums the square of autocorrelation. Q statistic and serial autocorrelation are useful in measuring the liquidity risk of a hedge fund. So you need to remember this thing. So that was it for this session. I hope this was useful. The next session would be on trust and delegation, and I'll catch you then. Bye bye and have a nice time.